Two undervalued stocks to consider in September of 2024. This is a series that I haven't done in a while, discussing two undervalued stocks for a specific month. I haven't done it, it's been a while. And I mainly discuss stocks that aren't too popular. Stocks like when I talked about GO last year at like 750. I talked about the next Costco stock, which was BJ's Wholesale Club. It's like a mini Costco, and it has done well. I discussed Sandstorm 470s, 480s, which hasn't done the best, but it hasn't been a loser either. I mean, it's been doing fine. And I don't talk about stocks like Amazon here. I talked about unknown stocks that I believe are trading at undervalued levels. And I have two very interesting stocks for today. The first one is more of a good company, quality company with high margins, but it's actually undervalued, trading at 15, 16 times earnings. Most of the good stocks, the quality stocks with high margins, you always have to pay up for them, except this stock, which I believe is trading somewhere near fair value. The second stock is more of a Monish Pabrai kind of investment. Like he invests in a lot of the stocks, like the coal stocks, because they have high free cash flow yield and they keep buying back stock. He calls them cannibals, I believe, or Uber cannibals or something like that. And this stock is very, very similar. And it has some kind of margin of safety, you could say, and a very high buyback yield. And you're gonna like it. And I hope you're gonna like them. But if you do, all I'm asking from you, if you could please press the like button and let me know what you think in the comments, if you like them, if you dislike them, so I know what kind of videos to make. If you like them, let me know you like it in the comments. That's all I'm asking. Okay. Now, the first stock which I'm gonna talk about is a stock I discussed before. And recently, some popular YouTubers have been talking about it, although I've been talking about it for a year and a half, and I used to own the stock. And it's called EVVTY, Evolution Gaming, or EVO. And it's mainly trading on the OTC and on the Swedish exchange. I believe it's also trading in Germany and in Europe somewhere. But Evolution Gaming is down over 19% over the last 6 months. I believe it's presenting an opportunity. If you're not familiar with it, Evolution Gaming, they create the content and the games that you play on your gaming operator. So for example, you the end user would go to the gaming operator, maybe, I don't know, Caesars or MGM or some kind of online casinos they have in Europe. Companies that made the game, they made all the content and all that stuff, is Evolution Gaming. And they get paid based on variable commissions and fixed fees, mainly through transactions and a lot of different things. It's a very good business model. They do have some kind of a moat, which I'm going to discuss. But in terms of the total gaming market, 75% is still land-based and only 25% is online. It's been growing, but I believe online should be a little bit more, as we have more of a society that likes to do things online from the comfort of their homes. And they could do that through companies like Evolution Gaming. One of the reasons why the stock has been struggling a little bit is because of the growth. If you look at the growth, they did grow 15 or 16% year on year, but quarter on quarter, it has decelerated from 501 to only 5.8. That's not even 1%. It's highly dependent on regulations, meaning the more state regulates, the more countries regulates, the more Evolution Gaming could grow its revenues. But if no more new states in the United States legalize, as you can see, the US market for them is a growing market, but it's not growing much because there's no new legalization. Europe is getting more mature for them. Asia is rapidly growing. So if more countries and more states legalize, Evolution Gaming is going to grow quicker in revenues. But if that doesn't happen, they're going to suffer a little bit. And their only way to grow is by increasing the popularity of their games and making new games. But for the balance sheet is still very good. 688 million in cash and cash equivalent. Current debt is like 715, so it's pretty well covered. The company has robust free cash flow and high free cash flow margins. They use it to fund a dividend. Their dividend is 3.8% or just 3%. It's one of their highest dividend yields ever, and it's been rapidly growing. So dividend investors will love this one. From 6 cents in 2015 to $2.65 as of 2023, and I believe they raised it again in 2024. And because the company believes their stock is undervalued at this price, they have been buying back stock a lot. And they haven't really bought back stock before in a major way, but now they're buying back a lot of stock through the free cash flow alongside with the dividend, because they believe that this is a massive overreaction in the market. And I believe the stock is undervalued. And this is always a positive sign from the management team and the company whenever they start buying back stock at such prices. But the company does have very high margins, over around 53% net income margins. It used to be 57%, but they had some tax rules that came in Europe. Now it's like 53.5%, and it's expected to be 53, 54%. This is as much as Visa. Visa has 53, 54%, and Evolution has now around 53, 54%. In terms of return on capital or return on invested capital, it's been increasing 25 to 27%. This is still very, very good. And the company with all these metrics is trading at 16 times earnings. I'm not trying to compare it to Visa, but just to illustrate a point. Both of them, they have the same net income margins. Visa is trading at 26 times earnings with 10% revenue growth. Evolution is growing 15% and is trading not at 25 times earnings, but at 16 times earnings. And for me, as a quality company that has some growth, that still has some runways ahead with a good balance sheet, very high margins, and still has 39% market share, I think Evolution Gaming at 15, 16 times earnings here, or around a 6% free cash flow yield, is providing a buying opportunity. And the company is not dead. In my opinion, it's trading more like a dying company, like it's never going to grow again. The growth has been decelerating from 50 and 90% to around 15% recently, and it's likely going to sustain 15, 16%, which is still cheap if you're paying 16 times earnings. This is like one-time growth, one peg ratio, and you're getting the dividend, which is growing rapidly, and you're getting some buybacks, you're getting a good management team, and you're getting 53% net income margins. So it's hard to pass, or it's hard to beat the value that Evolution Gaming is providing at this price, and it's extremely interesting stock. And I think this stock is a buying opportunity here. Not financial advice again, it could always go lower, but I'm just saying that it's offering tremendous value for what you're willing to pay. Okay, this is the first one. The second one, which is more of the Monish Pabrai stock, and some of you might not like it. I mean, a lot of you like the oil stocks and stuff, or a lot of the cyclical stocks, but this is a special one, and I think you're gonna like it. And this stock is called MPC Marathon Petroleum. It's still up 16% on the year, but it's down around 19% from where it was trading on at 52 weeks high. Maybe a lot of you know more Valero and PSX. But MPC is kind of the same thing with the refineries, but they have some kind of a better business model that I'm going to discuss. Valero, for example, is 100% focused on refineries. MPC isn't. MPC does have refineries, and it's the largest in the nation, I believe. It's the largest refiner in the nation, and they have refined around 3 million barrels per day, and they have 13 refineries in the United States. And as you know, it's extremely hard, almost impossible to build new refineries. They haven't been building them. They've been even shutting them down in some states. They've been shutting down those refineries. And refining capacity is getting tighter and tighter, not just in the United States, but worldwide, which will allow higher refining margins right now and over the long term. And that's a good thing for MPC. These are extremely valuable assets that I don't believe you can build today. I mean, you could build them, but it could take, I don't know, 6, 7 years. I think it takes 10 years or something crazy to build a refinery. And, forget getting the approval and all that stuff, especially if you want it in the United States. I mean, I would assume that's extremely hard. They've been shutting them down. But this is the cyclical part of the business. Not the whole company is cyclical. A lot of you think all the oil stocks are cyclical. This is not really true, but especially with a company like MPC. All right. Now, for them to determine the profits on refining, when they refine it, meaning they take crude oil, they make it into gasoline, into diesel, and into all those things that you consume. This is how, by the way, they ship it to other places around the world. And that's why US refiners are, I read an article, they have a better advantage over EU refineries, not just because of regulation, but because of the price difference between crude oil, West Texas, and what they have in Brent oil, which is what they have in Europe. And crude oil always trades a few dollars cheaper than Brent, which makes US refineries better for exports because they can refine the product into gasoline, and they can expand them, and they can export them to places around the world, and they will still get it cheaper, and it's much better quality. So exports is extremely bullish for this company, especially from a national security standpoint and many different things. But what really determines their margins is something called crack spread. Now, I'm sure you heard a lot about the crack spread. but especially in, I should say, 2022. And you saw stocks like Valero. Valero is 100% in refining, and crack spreads, they skyrocketed from like 18 up to like 58 or 60. And this is because of the war in Ukraine. A lot of the refining capacity shut down. Some capacity was shut down in China from the COVID stuff. They had still been shutting them down. So there wasn't as much refining capacity as was needed, and there was very high demand, not enough refining supply. And this is what happened, and those spreads skyrocketed. As they used to go as low as 9, they went up to 60, and that was extremely unsustainable. Something like Marathon Petroleum and Valero, they benefited a lot. They used a lot of free cash flow, like 5 or 6 times what they normally get, and they did massive buybacks. They paid down the debt, did dividends, and did many different things. And the market got excited about them, and they loved them. And now the margins have normalized, and they went down from 60 all the way down to like 16.9. So 16.9 is more around the historical average, 16, 17, 18. Also, we have less refining capacities than we had before. We have more demand around the world from countries like India and countries in Africa and in many different kind of emerging countries around the world. We have more demand and we have less supply. So I wouldn't be surprised if the crack spread ends up being more than 15 or 16 in the long term, 20 to 25. And that would make a huge difference if you're investing in a company like PC. The second part, which is the exciting one, is midstream. And midstream is one of their businesses, and it's mainly based on how they transport the gas. Upstream is when they drill it, they produce it. Then they have midstream, and when they transfer it, maybe with the trucks, maybe when it was the pipes, which is it's the pipes in case of MPC. And then this downstream is, again, where they have the refining stuff and where they actually make the gasoline and all these things. And this is a picture of an example of midstream pipelines. And I do have a pretty amazing business model, actually, and it's pretty recession resistant, and it's solid energy infrastructure. I mean, you can't really get any better than that. You have the pipeline is built here. I mean, you're not going to just go build another pipeline and start competing on that stuff. So it's more like railroads, and it's like a toll bridge, you could say. And it's a pretty amazing business model. And I do have exposure to this area through MPLX. And MPLX is a subsidiary of MPC, and they own 60% of MPLX. And this is an example of a pipe they're building in Texas. This is not going to be done before the second half of 2026. But this is mainly the business model. I hope I didn't make it too complicated. And this business is spitting out $2.2 billion annual distributions to MPC, meaning it distributes dividends. MPC collects $2.2 billion from MPLX every single year in dividends. And this dividend has been growing 10% every single year from MPLX. And they do control MPLX. They own 64% of the company. So they have been increasing their distribution 10% per year. And now it's at $2.2 billion, or around 550 to 560 million a quarter. And this is recurring. It's always going to come in, and it does nothing but it goes up. Okay. Now, the best part about it is if you look at CapEx, the capital expenditures, they're around 569 million. So around 550 to 560 recurring from MPLX in terms of dividends is enough for them to cover the CapEx. So they have all their obligations pretty much covered from MPLX or the mainstream business, which is more of a recurring revenues. Then they can use 100% of whatever they get from the refining business, which is more cyclical, for them to do massive buybacks and do dividends. And this is what the company have been doing. You could look at the buyback. It's from 654 in terms of shares to 350. It's been massive. They bought back a lot of stock, and they did mention on the earnings call they're going to continue to do so, and they're paying around a 2.2% dividend, which isn't the best ever. So you have a part of their free cash flow is growing 7 to 10% every single year, and it's not as cyclical. And in 3 years, if that continues and it gets to 2.9 billion, then that will be enough for them to not only cover the capex, but also cover their 2.2% dividend, meaning they can use 100% of whatever cash flow is left from the refining business to do a lot of buybacks and pay down the debt and do many different things. So the company isn't really as cyclical as you believe, because they have 50% of their free cash flow growing 10%. It's going to grow 10% for years and years to come, and it is not cyclical. The second half of their free cash flow is the cyclical part, and it's likely bottoming out in terms of the spreads. And I do have valuable assets that are very hard or impossible to replicate, and they're not really building them anymore. And if you look at the free cash flow expectation for 2025, which is a little bit hard, they had very high free cash flow before, mainly because of what they had in terms of the crack spread. It went to 60, and they had different businesses. They sold some of them, but it's expected around 6.3 billion for 2025. And I believe from the growth in MPLX, this is likely very, very accurate. Now, the 6.3 billion in 2025 would come out around an 11% free cash flow yield. So you're getting an 11% free cash flow yield on the company, and half of this free cash flow is going to continue growing 10% per year, and they're using it 100% to do buybacks and do dividends and many different things, but especially buybacks. You could look at the 5-year chart of the company. The company has done amazingly well. It's turning more like an NVR or an AutoZone, where you just keep buying back stock and the stock keeps going higher because they have resilient recurring free cash flow. And it's an amazing effect over time, just like the coal stocks that Monish Pabrai has. But I believe this one is better because they have better valuable assets, and at an 11% free cash flow yield that's actually growing, where you're bottoming out on the crack spreads. I think this stock is extremely undervalued, and it could deliver around 15-16% a year at least, in my personal opinion. And the balance sheet isn't as bad. They have 4.4 billion of cash for short-term investors, like 8.5 billion in cash and cash equivalent short-term liquidity. MPC's debt is 6.8 billion. So they have more in cash than they have in debt. Most of their debt is in MPLX, which is their subsidiary, and they own 60% of. 22 billion is on the pipeline, of the midstream pipeline, which I believe it should be leveraged up as much as possible. If you look at the total debt, then it's like 29 billion. It's scary. But in terms of the parent company, they have more cash than they have in debt. So they couldn't be better positioned to do buybacks, increase the dividend, grow the free cash flow, pay down the debt, and do amazing things for the company, for MPC and MPLX. So that's my 2 picks for today. The first one, you might have liked it better. The second one is a little bit more complicated, but I think because it's complicated is why it's right now offering an amazing buying opportunity, even though maybe the chart doesn't say so. But I still believe it is, and it's much better than Valero, because Valero does not have the recurring revenue from the midstream business. And that's all I have to say. Thank you for listening. Thank you for watching. I hope you enjoyed it. If you did, please press the like button and maybe consider subscribing. So I'll talk to you in another video.